Wednesday, August 24th, 2022, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at index-linked gilts. Yes, they're kind of a government bond from the UK that I think could create havoc in public finances. And yes, it will be definitely related to the UK debt time bomb, which I spoke about a week or two ago. And it could be the trigger for hyperinflation. Yes, it's that serious. And I think, unfortunately, the general public is asleep to those problems. The problems, the precarious state of UK public finances. Yes, they're aware of the energy crisis, and that's related to all this as well, of course. So we're going to look at the index-linked problem. It's a huge problem, and I have to thank one of the viewers for reminding me of that. And I had a dig into it, and we're going to go through it. So first of all, we're going to go to the United Kingdom Debt Management Office website to see what an index-linked gilt is, so we can know what it's all about. It says here the UK was one of the earliest developed economies to issue inflation index bonds for institutional investors, with the first index-linked gilt issue being in 1981. Index-linked gilts differ from conventional gilts. Those are the conventional government bonds. Conventional government bonds, they pay a coupon every year, and it's based on the interest rate in the market or yield. So I'll continue. In that both the semi-annual coupon payments and the principal payments are adjusted in line with movements in the general index of retail prices in the UK, also known as RPI. A conventional gilt, let's say you buy a 10-year gilt and it gives you a coupon of 3%. So you put £1,000 in there, you're going to get £30 every year, and that's fixed, that coupon. But if you buy an index-linked gilt, you will get whatever RPI is. So the higher RPI goes, the more you're going to get. The more it's going to cost the government to pay the investor. So yes, recently I spoke about the UK debt time bomb. That yields are going higher very quickly, especially in the 10-year. But even if yields were, let's say, to plateau around where we are right now, and I don't think they will, you could still have the RPI continue to rise, and the government interest payments continue to rise, especially when we've seen recently that Citibank or Citigroup is calling for the CPI actually to be at almost 19% by the end of the year. And remember that the index-linked gilts, they're linked to the RPI. And the RPI right now is about 2% higher than the CPI. So we could get the index-linked gilt having to pay 20% or more in terms of its kicker for investors. So, and it's a huge problem. And why is that? Well, here we go to Her Majesty's Treasury website, where they talk about the debt portfolio of the United Kingdom. And you can see here, it's on page 17. This is a pie chart. It's the composition of the central government sterling debt in percentage and billions as of the end of last year, December 2021. And you can see that index linked, which is the light gray pie piece of the pie, That's almost up to 500 billion. I would say it's probably above 500 billion now because they probably have issued more index-linked gilts, and it's almost a quarter or 22% of all UK debt. So keep that in mind, because I found a few articles as well. One from the Guardian, which is about a month old, and the other one actually came out yesterday in the FT in their Lex column. And it's weird that it came out when I was looking at that. I had tweeted about that, and they've come out with a warning about index-linked gilts. Before we go further into these articles, I just wanted to bring up the energy situation. Yes, that's a huge problem right now, and I think the general public is well aware of it. And I think whoever becomes prime minister, and it looks like it's going to be Liz Truss, it's going to be like a Pyrrhic victory for her, I would say. She's going to get a huge crisis on her hands, a little bit like Andrew Bailey when he replaced Mark Carney in the beginning of 2020. Did he know everything was that the proverbial, I don't want to say the word, was going to hit the fan in 2020? I don't know. Maybe he did. But there's an article here this morning in the FT, shielding UK families from fuel bills crisis, forecast to cost £100 billion. So that's very much related to UK public finances, because who's going to pay for that? Well, it's the UK government. Of course, it's us. In the end of the day, the taxpayer, we pay it through higher taxes and a currency that becomes worth less and less, i.e. that's the definition of the consequence of inflation. I've read through this article. Basically, executives in the energy industry, in particular the chief executive of Scottish Power, which is one of the big six energy suppliers, he's saying the government has to cap energy bills at 2,000, even though the prices are going to go through the roof above that 2,000. But who's going to finance that? Well, according to him, the companies are going to be able to use a deficit fund, and eventually they'll kick that down the road, and the government will pay for it, or taxpayers will pay for it for the next 10, 15 years. I mean, it sounds all very good. It's another kicking the can down the road. One of the interesting points about this is, if you read down through the article, there's a part that says here, and I'm going to put a link to this article in the description. Yes, you'll be able to read it. It's going to be under archive.ph, where you don't have to pay for it. But it says, the plan would cost more than the coronavirus furlough scheme that paid millions of salaries during the lockdown phases of the pandemic. It cost $69 billion between March 2020 and October 2021. So what happened after the pandemic and all this government spending? Well, we've had higher prices, what they call inflation, a cost of living crisis. So they want to use the same strategy to solve an energy crisis. And it's really amazing, because if you read a little further down here, this is what they're saying. I actually laughed on my own here with Billy. I thought it was crazy. It said, people familiar with the talks said the proposal could help cool inflation in the wider economy, although many small businesses which are not covered by the price cap may need additional support. I mean, and that's why I think we're going to get a hyperinflation, because that they did the same thing in Germany in the 1920s. They printed more money to solve an inflation problem, and it looks like we're falling into that trap. So back to the index-linked gilts. This is going to add on to the debt, and maybe the government won't issue as many index-linked gilts, saying that RPI is going through the roof. Who knows? But as you can see here, soaring inflation pushes interest payments on UK debt to record high in June. That's from The Guardian, of course. Potential for future tax cuts narrows with budget deficit on course to top 100 billion this year. 100 billion, that would be about 5% of GDP. And I think it's going to be a lot more. If you look at the, so we'll go now to the FT article on the Lex section. It says, government debt index linking is backfiring for Britain. Soaring UK inflation has exacerbated the pain of excessive debt. So just remember, we've got $500 billion of these index-linked gilts. So if RPI were to go to, let's say, 25%, right now it's 12%, that would be an extra 65 billion pounds in interest payments that the Treasury has to find to pay investors. But let's go through this article. It's a short article and it will help you understand a little more what's going on. Higher prices in the UK will not only squeeze the pocketbook of the average Briton, it will also hit the government hard. Talk of double-digit inflation this winter. Well, we already have it now. Citigroup now thinks the rate could surpass 18%. Yes, that's for the CPI. Comes as energy prices continue to soar, but the country's over-reliance on inflation-linked debt will mean punitively higher financing costs too. Britain pioneered the issuance of index-linked bonds, or linkers, in the 1980s. Yeah, we went through that, with the rationale that the government's commitment to reducing inflation directly lowers borrowing costs. This would remove any temptation to inflate away the debt. The premise has proved flimsy in 2022. UK government debt now equals its annual economic output, 100% debt to GDP, one of the highest proportions of any developed economy. Soaring inflation through inflation adjusting has exacerbated the pain of excessive debt. Linkers, or that's how they call them, make up almost a quarter, as we saw, of total UK central government debt of £2 trillion. Compare that with just 8% in the US and less than 5% in Germany. UK government interest payments in June more than doubled to 19.4 billion this year. This increase is entirely due to the rise in semi-annual linker payments connected to a surging retail price index, which includes mortgage rates. This measured inflation rising at 12.3% in July. So at the same time, the Bank of England is having to raise rates. That's going to push mortgage rates higher. The other thing that the Bank of England has a problem with is that they've promised to start selling the securities on their balance sheet in September. They're going to sell gilt. They might sell some of these index-linked gilts. They also have mortgage-backed securities. They might sell that. That will mean even higher rates. It's a vicious circle that we're in, unfortunately. In March, the UK's Office for Budget Responsibility had forecast interest costs to hit 84 billion this fiscal year, about the double what it expected at the end of last year. So things are getting a lot worse very quickly, and our economy is not supposed to be in a recession. Can you imagine when it really gets in a recession? Things are going to get even worse because tax receipts are going to go down. That burden will continue to pile up. Capital Economics expects an extra 30 billion to be paid on top of that. An average RPI rate of 15% next year would boost the cost to almost 130 billion. So that would be about 6.5% of GDP. That's just the interest cost. That's not the rest of the deficit. Lex calculates, and that does not include the impact of any additional interest rate rises by the Bank of England. Even without these, borrowing costs alone would equal to about 5% of GDP. That could push spending on debt servicing above that of Europe's most indebted country, Italy, if the latter's interest costs rose by 3 percentage points, thinks S&P. Those kinds of numbers should send a message to UK policymakers to clamp down on inflation, and soon. Well, it doesn't look like they're going to clamp down on inflation because they're thinking of helping the public, or they're going to hurt the public. But they're saying they're going to help them with another $100 billion in financing for the energy crisis. So I'm not trying to sound alarmist or scare people here. Far from that, I think there will be opportunities, even in such times where we could eventually see the UK have to call the IMF like it did in the 70s. It went bust. The government was insolvent. But on an individual basis, we can run a tight ship, economic ship. Economy, after all, means household management. And if you've been following me the last few years, I've spoken about this, that this was coming and that we needed to prepare for it. And if you have prepared, I think there will be big opportunities to even thrive in such conditions. Yes, it's not nice to see the general public suffer, but we've been trying to warn them, and hopefully we will have awakened quite a few people. But we can't really tell everyone. A lot of people don't want to listen. And of course, the key thing here that we need to take from this is that our currency, the pound, is going to shrink even more in purchasing power. And what do you want to do in such a situation? Well, you want to spend it and get rid of it as much as possible. And you want to have tangibles, anything that's real and that you can hold. And of course, gold and silver are part of the program. And this is just my opinion, of course. So with that, let's quickly look at where the markets are this morning. It's 8:36 a.m. London time. We've got spot gold at $17.45. It's down just over $2. High's been $17.50, low $17.43. Yesterday we had very weak service PMI numbers in the U.S. They're actually showing a recession. They dropped. They plummeted to like 44, and yes, we'll have to see what happens in September with the Fed and its next rate decision. I think on Friday this week as well, we've got the Jackson Hole Symposium, which is held or organized by the Kansas City Fed. And people are going to wait and see what Jay Powell says there. I think the markets could react to that. So silver down 7 cents at 1904. High's been 16, and the low 1900. The Dow futures, that's down 118 or 1/3%. NASDAQ 100 futures down 57 points or 0.5%. And so is the S&P is down about 0.5% or 16 points. The FTSE is down 50 points or 2/3% at 74.29. Eurostoxx 50 is down 23 or 2/3% at 36.27. To the currencies, yes, yesterday after that PMI number from the US, the currencies rallied and the dollar dropped. Again, I've said that many times before. All these fiat currencies are sinking. Some of them will sink faster against each other, or one time one of them will rise and the other will sink because they have to in relative terms. And that's what we see. In the end, of course, they'll all sink completely versus real things. But right now, Sterling is down slightly at 118.24. I think we got down to 117, near 117 yesterday, so it has rebounded a little bit. The euro is down 0.2 at 99.50. The dollar is down slightly versus the Japanese yen, 136.60. Dollar is unchanged versus the Swiss franc, 96.36. And the dollar's up a third versus the yuan at 687.50. And the dollar's up slightly, trading around 60 versus the ruble. We'll check some of the other currencies now. Aussie dollar is down a quarter, 69.11. Dollar is up 0.2 versus the Canadian dollar, 129.78. And the Kiwi dollar is down a third at 61.94. To the general commodities, WTI crude is rebounding. We're almost back up to 95. It's at 94.15, up 2/3%. Brent crude is just below 100, 99.80, up 0.5%. High-grade copper is down 0.5% at 367. U.S. nat gas is up 2% at 932. European TTF nat gas, well, that's drifted off a little bit. It's unchanged. It's trading around 270. I think we got almost up to 300 yesterday, intraday. So now we're going to look at the bond market. We're going to start with the UK 10-year yield because I've warned about that as well, aside from the linkers, of course. But the UK 10-year yield is fast approaching that level I spoke about a few days ago of 2.7. I think if we break through that, it could be very serious. It will make things even worse for UK public finances. Well, right now the 10-year yield is at 264. It's up another 6 basis points. Just to give you an idea, we started the year, the 10-year yield was around 0.7. So now it's approaching 3%. You can see what that will do to mortgage rates, because mortgage providers will not keep their mortgage rates low if the government borrowing costs are going up or the Bank of England is raising rates. They'll raise it as well, of course. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.